Before we do get started, though, I'd like to remind you this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research. And of course, trade responsibly. All right, but yeah, let's go ahead and jump right in, get it started. So obviously, if there's ever a time of year where we would expect for there to be a pivot in one direction or the other, this is it. So it's pivot time. And when I say a pivot, it could literally be continuation or it could be a reversal. But if there's one time of year that it's more likely to see a pivot in different markets, and I'm not talking about one market or another. I mean, we could literally see gold go parabolic and everything else that's been pumping crash. We could see everything that's been pumping keep pumping. We could see everything pump, everything crash. Who knows what's going to happen? But the likelihood of there being, a game-changing event at like the beginning or the end of a year or a quarter or a month is like exponentially stronger on longer time frames. So when we get to these key pivots like end of the year and we have catalysts like, tax loss harvesting or taking profits, on your portfolio to lock in gains or, potential tax increases or Fed rate hikes or, tapering, all these different things, that's when they really start to materialize. So the market can price in everything it wants for as long as it wants. But the truth is, it really starts to materialize when it becomes like, an actual thing in the markets based on those like swings, those, periods of time. And typically the longer the time frame, the more likely that is to occur. So, the same way that we like rebalance every quarter, you expect like the rebalancing at the end of the year, the taking profits, the tax loss harvesting, all that stuff to be like exponentially more powerful. So this is the time. And, to tell you the truth, we're seeing basically, we're getting clues from some of these markets that we're likely to see some pivots play out. So we've been displaying quite a bit of bearish divergence on a bunch of our different assets. And also we've been showing quite a few, things that have just gotten absolutely hammered or consolidated sideways or just beaten down to an absolute pulp. And the likelihood of those things recovering now seems more likely than not. We talked about specifically how we expected concentration into the strongest names, indexes, but like specific stocks going into the end of the year. And, then some light selling. And we saw exactly that happen. So, essentially, if somebody is upside down in one of these stocks or cryptos or whatever, they can harvest that loss, use it to offset some of their gains. And then you see mild selling in some of the more powerful stocks. And then you see exponential like capitulation selling in things that have gotten beaten down as more and more people want to take the L on these things. Well, they don't want to take the L, but they want to lock in the L to offset their W's. And I think that's exactly what we ended up. I mean, not even I think. That's exactly what we ended up seeing. We saw a bunch of these like high flyer tech names that have no profits just get absolutely hammered, into the dirt. I mean, beat down into the dirt and bloodied, left for dead. So is it possible we see some of those things recover? Is it possible some of them just go straight to zero? Both those, definitely a possibility. And matter of fact, I would legitimately be willing to bet that some are going to do exactly that. Some are going to rebound and be strong for the next few months, years, whatever. Other ones are just going to literally, curl up and just bleed out and die. So, which ones? Well, we got to figure that out. We got to let the market tell us. So, but, we saw bearish divergence playing out on crypto on weekly time frames, on the total crypto market cap, on Bitcoin itself, on quite a few altcoins. Lots of the cryptos are off their highs, substantially, some more than others. We see that happening with the major indexes. Dow Jones, bearish divergence on the weekly. S&P, bearish divergence on the weekly. NASDAQ, 75% of it is below its 200-day moving average. Absolutely been beaten down. Russell, been trashed for an entire year. Looks like it's getting ready to just go straight to zero. I mean, there's going to be some money to be made this year. But I'm going to tell you the truth right now. People are going to lose big too, especially if we start to see a shift in these markets. Because think about how many people entered these markets over the last 2 years and they don't know what it's like to not be able to buy the dip. They don't know what to do when you buy the dip and then you lose 50%, and then you buy the dip again and you lose 50%. And they say, well, it's already down 50% and 50%, so it can't go any lower, right? Hey, how about you get another 50% haircut? Talk to me after that, and maybe one more after that. Talk to Michael Saylor in 2000. It can't go any lower, bro. It's already at 0. What's up, brother? Good to see you, man. Yeah, I'm excited for 2022 myself. So let's jump in and rip a little bit of this technical analysis. So we see the 10-year has rallied back above the 200 exponential and simple. 200 simple started to roll over, but recovered those levels. 8 and 21 are crossing to the upside. We see a bunch of green histograms crossing over the 0 line and the slope line, gaining momentum to the upside. Looks like the 10-year on the daily wants to pop up here. Looks like it wants to jump up. Let's check out our monthly. So look, we got the 821 cross in this elongated bear trend. I mean, this thing has been getting absolutely beat down and just absolutely dominated since the 1980s. Okay, since the 1980s, the bond market has been in a parabolic uptrend, and the treasury yields have been in a parabolic downtrend. And now what's happening here? Well, probably a reversion to the mean. We see it happen how many times? Beat down, reversion to the mean. Beat down, reversion to the mean. Beat down, reversion to the mean. Again. And now here, what are we doing? Possibly again. I mean, I would think likely. We're at some key resistance based on these two previous lows right here, chopping around through those levels. But, you know, it looks like this wants to rally up here. It looks like a temporary rejection off the bullish control zone on the jewel thief right here. Just like we saw right here. A little temporary rejection, refuel the jet, and then take off into the stratosphere, into the atmosphere, bullish control zone, and then we top out eventually. You know, where are we going to top out at? Is it going to be 2.5%? Is it going to be 2%? Is it going to be, 3%? Well, we got to wait and see, but we're definitely building up momentum. And now with the 821 crossing to the upside, likelihood is we're going to see, and then take into account the fundamentals, Fed's talking about specifically raising rates. They're tapering their balance sheet. 120 billion per month in asset purchases going to stop happening, or start to stop happening, or happen less. I don't know how you want to word it exactly, but I mean, this thing is in the most powerful, longest beat down downtrend ever. So is it going to go to new highs? Probably not, but it looks like it's going to keep moving to the upside. We have momentum above the 0 line, above the slope line. All it has to do is just literally not capitulate back down here. The slope line is going to flip back over blue. So people want to ask me, is now a good time to dollar cost average into bonds? Should I buy bonds? Should I flee to safety to bonds? Well, I don't think so. I mean, maybe. Sure, maybe it works for you, but to me, I don't want to buy the other end of this, because whatever this looks like, whatever the opposite of this is, this looks like a capitulation bottom. So, what's the bond market look like? A blow off top? Well, probably. What happens after the blow off top? Reversion to the mean. A retest of the 200 exponential and simple. So what happens with a capitulation bottom, a V bottom like this? You know what I mean? You run out of sellers, you go to 0, and then bounces back, and then reversion to the mean. And then once we get back to that mean, once we get back to a 200 exponential and simple on the monthly, then we could decide what's going to happen after that. It could very easily get rejected, come back down, sweep the lows again. Could very easily break through that and break out of, this 40+ year downtrend. And let's keep in mind, this is the oscillating range right here, and the top of the range is the 200 exponential and simple moving average. And if we turn off log scale and just go to our traditional, we see we're just trading inside a channel meticulously, almost perfect. And where are we at? It's tough to tell because now you got to look at all my little drawing tools. But we're right smack down in the middle of the channel, getting ready to potentially break through this inverted head and shoulders. So to me, bonds don't look so safe right now. I don't know who coined the phrase or who said it first, but what people ask me about bonds right now, bonds look to me like a reward-free trade. I mean, all the risk, none of the reward. So you got to worry about, you're guaranteed locking in negative interest rates if inflation continues. So you're automatically losing money. You're going to give the government money full on knowing 100% that the government is going to give you back money that's worth less in the future. So you're for sure losing if inflation continues. And then, so that's losing. That's a lose situation right there. Here, you want to borrow some money? Sure. Hey, don't even worry about giving me all of it back. Just give me most of it back in the future, via buying power, obviously. And then, give me a pathetic interest rate that's basically useless, that's getting absolutely dwarfed 10x by inflation. Assuming it's at 15%, maybe it's 6x because inflation's at 9%. Will we persist and see quote unquote official numbers 6%, for the next 10 years? Probably not. I mean, obviously not. There'd be riots in the street, but the fact of the matter is, that's your one situation. Inflation continues and you get absolutely wrecked. What's the other situation? Well, the other situation is that the rates do rise, we end up going into like recession or depression because the economy is just being propped up by all this fake money and stimulus. And then what happens to the bond prices? The prices fall. So you lose money on your principal, or you lose money on your interest, compared to like the real rate versus, the coupon rate. So when you adjust for inflation, you either lose money in buying power or you lose money in principal. So what is the situation where you win buying bonds right now? If there is one, I don't fucking know what it is. I can't figure it out. Maybe I'm missing something, but people ask me, should I put my money in bonds? No. No one's putting their money in bonds. I mean, somebody is, called the Federal Reserve, but I don't think anybody else is. I mean, look at the bond auctions. I mean, there's definitely some people putting money in bonds. A lot of like, old school asset managers, big money, hedge funds, whatever. Sure. Nobody's running like 60-40 portfolios, maybe 80-20s. Maybe some people are just locking in that fixed income. But I mean, at what point in time, if you have volatility in the bond market, you might lose your principal. And then you have volatility in the stock market, you might lose your principal. And the stock market's been absolutely decimating the bond market. Why would you ever put your money in bonds? You wouldn't. You just go for the risk on. You go for the risky asset that's been paying you. I mean, S&P up, 26% or something, 28% last year? I mean, bonds did okay. Did they do 28%? Did you lock in, S&P paying you 2.5% dividends? Did you lock in 2.5% dividends on your bonds? Well, it depends when you got them, I guess. But, you're going to lock it in right now? No, you're not. You can get screwed. But anyway, that's my macro on it. I had some people asking me about bonds. Was now a good time to buy, etc. I don't think so. If you live in a different country, maybe, it makes sense because your currency is liable to implode or get wrecked compared to the dollar. But like when I say, and this is a distinction I want to make here real quick too. When I say that I have like large cash positions, I have temporary large cash positions. Holding a large cash position does not make sense over time because you're losing buying power. It's a fact. You can look back at the chart and the dollar's getting absolutely crushed. The DXY, or compare the dollar to like actual assets. Everything looks like it's going parabolic in prices. Houses, stocks, cryptos, but really just all the fiat currencies are losing their value. Gold looks like it's up a bunch, maybe not recently, but if you compare 20 years ago, 30 years ago, 50 years ago to now, it's up a bunch, but is it really up or is it just maintaining your buying power? And that's what it's really all about. It's about maintaining your purchasing power. So when I say I have large cash positions, I have large cash positions because I'm ready to deploy them into the market and take advantage of big drawdowns, not just to like hold on and like put under my mattress and like chill on. And then if you think about like, if I want to have short-term cash positions so that if we do see a crash or a pullback or something like that, if I'm ready to deploy, I don't have to sell something else and then now have to, reaccumulate with my lower dollars because whatever I sold probably went down too. Because let's be real, the correlation in all these markets is extremely high. I mean, what happened during the Rona dump in the beginning? Gold went down 20%, silver went down, 40, 50%, cryptos went down 60%, S&P, Dow Jones all went down 30%. Some of the other, stocks 60%, 70%. I mean, so where was the safe place to be? Where was the safe place to be? It was cash. It was bonds temporarily, but the bonds are not liquid in the same way that your cash is, your cash is just ready to go. So that's why, what is a bond? It's basically a future promise of cash. I'm going to loan you US dollars now, and you're going to give me a certificate and promise me you'll pay me back that money I loan you. You're going to do whatever you need to do with that money, but you promise you're going to give it back to me. And then in the meantime, you're going to give me a coupon percentage of that money that I loaned you. So it's a future promise of dollars. So if I don't want to have a long-term cash position, I only want it as an option on these markets because something's going to pull back. I don't care what it is. Something that I want is going to get real, real cheap. And it has been. We've seen it happening. We saw it happen in crypto. We scooped the dip. We saw it happen in, it's happening still in pot stocks. We saw it happen in tech stocks. We saw it happen in so many different things. And if you have to sell out of something else to buy into these, you're at a huge disadvantage. And that's why the cash position is an option on these markets, an option to buy whenever you want. And that's why I like to have a large cash position. But I'm not planning on maintaining a large cash position for 1 year or 3 years or 5 years or 10 years. Like, I'm not hodling dollar bills, y'all. And I just wanted to clarify that, because sometimes when I say I have a large cash position, I don't think people understand. I mean to deploy. Like, I'm waiting for opportunities, waiting in the swamp, red eyes, lurking out of the water for that gazelle to get close so I can leap up and sink my gator teeth into it and drag it to the depths. That's what we do with our cash. We don't just hide it. You know what I'm saying? I'm not just dragging that gazelle down and just hiding him under the mud and I'm going to go eat his rotten, half-done carcass 2 years from now. No, that's not what I do with my dollars. I'm waiting to deploy them at every chance I get. So that's what the cash position is all about. So when I talk about that, I want to be crystal clear that under no circumstances do I want to be holding cash for elongated periods of time. No matter what the DXY chart looks like, I do not want to hold cash. Because while it's relatively gaining strength compared to the basket of currencies and other worldwide currencies not in this basket, this is literally just giving us a relative strength to the other currencies, not to the actual assets. Because all the assets we see going up, houses, meat, corn, coffee, lumber, gold, well, maybe not as much gold lately, but maybe soon, cryptos, stocks, all these things are going up relative to dollars and other currencies. So even though the dollar is gaining strength compared to the other currencies, that just tells me I want to have my money invested in the United States if the dollar is going to go into a parabolic uptrend, because it's going to be going stronger compared to these other currencies. So that's giving me the worldwide view of where I want my money to be. But I still want to be putting my money into, assets and speculative plays. I don't want to just be holding cash, no matter what the DXY chart looks like. So again, just to clarify, I know most of you guys know that, but sometimes, it helps when I just blatantly state it and use like alligator and gazelle metaphors. I know that helps because you can picture the situation in your heads. So anyway, hopefully I painted you a picture of what I'm talking about. But here we have the DXY monthly chart. And what we see here is on the monthly, we confirm that 821 cross on the monthly. Okay. Most of the time when we have done that, this was, over a 1 year period of bullishness. This time when we confirmed it right here, this was in June of 2014. It didn't top out. It didn't cross back over until July of 2017. This is a 3 year period. This is a 1 year period. This is a 6 month period. This is a 6 month period. That was just a little touch up here. This one right here is from 96 until it crosses back down in 2002. So we're talking about 6 year periods. So we're talking about long periods. So when this cross up right here, when we look at this monthly chart, we have one instance where it lasted for, 3 months, a couple months. So if we're just in the beginning of this cross up here, the likelihood of it playing out to where this move in the dollar, the strength in the dollar, plays out over a minimum 6 months, 10 months, 12 plus months, 3 years, 6 years, the likelihood of something like that playing out, and that's just based on the 821 crosses on the TJD Master. But then when we take into account, the big picture, and we look at the monthly 200 exponential and simple, we see that basically the dollar has been in a bear market, crossed below the 200 exponential and simple in 2003. And we didn't confirm back above the 200 exponential till 2014. So it took 11 years to get back on top of the 200 exponential. It took longer than that, came down and retested it, and then retested the 200 simple. And then we finally flipped the 200 simple blue for the first time on this entire chart in 2020. So technically we went into a bear market on the dollar by how I determine it in 2003. So for 17 years, the dollar was in a bear market technically on the monthly chart compared to this other basket of currencies. And now we're entering a bull market. We just entered a bull market and people are saying the dollar is weak. It's trash. I don't want it. I'm investing in emerging markets. Are you sure? Are you fucking sure? Have you watched the news? Did you look at this chart? I mean, this is not financial advice. I'm not your financial advisor. You could do whatever you want, but I'm telling you what I'm doing, and what I see right here is safety. And where do I see that safety? I see it in the dollar, in the DXY, in comparison to other currencies in this basket. And, you could look at, Canadian dollar, you could look at euros, you could look at British pounds, you could look at, whatever other currency you want to look at, one that's not even in this basket. And it might paint a different picture, but overall, this gives us a broad picture of, the dollar's relative strength. And it's most important to look at the dollar because it's a world reserve currency in comparison to other currencies. So while some might look better than this compared to the dollar, some might look worse than this compared to the dollar. Like if we pull up the lira is getting absolutely destroyed right now compared to the dollar. If we pull up the Canadian dollar, it's slightly stronger than this chart is right here. But when we look at the basket, we get the broad picture. And here we have a hard buy signal coming out of the bearish control zone. We have an 821 cross. We have 200 exponential and simple both flipping over blue. We have the slope line on the histogram above the slope line. The slope line is flipped over blue. The slope line is above the zero line. We literally have everything on the DXY monthly chart. Every piece of every one of these indicators is screaming bullish. And on a monthly chart, we know what that means. We know exactly what that means. We know it's got a very high likelihood that this plays out over, here when we got that little false signal, we crossed over, never flipped the slope line over blue. And we were already inside the bullish control zone before we got that signal. Here, we flipped the slope line over blue. We know we're about to go into a long trending uptrend on this. We could easily have a pullback. We could see a temporary rejection. We could come back down and put in a higher low before we get continuation. But I'm telling you right now, what this chart is screaming is dollar strength in relation to other currencies. So that's what I'm paying attention to. I trust technical analysis. Can it be wrong sometimes? Yes. But is the probability when we trade with the trend extremely way, way, way higher than when we trade against the trend for long-term moves? It is 100%. We're trading with the trend. We're allowing the momentum of the markets and the market makers, the market movers, the smart money, the big money, the whales to make decisions for us. Because they're telling a story right here, and we're just reading it and then interpreting it. It's in a different language, so some people can't understand it. But we read it out loud to them, and we can help them understand. And that's what this is all about. It's about understanding what the chart's saying, what the whales are telling us. And they're telling us the DXY is strong. It's going into an uptrend. Now here on the daily, we see, basically getting a little 821 cross. We had a little one right here. We had a little one right here. We had a little one right here. But again, on the daily, 200 exponential and simple slope to the upside, we're seeing what looks like to me a bullish reset. Does that mean we can't come back down to like 94 and lose this key support? No, I wouldn't even be concerned at all if we did. As a matter of fact, I would really like to see this come back down to like 93.14, retest our breakout, retest this previous support, watch it hold, put in a higher low, and then we could catapult to the upside. Because when that doesn't break, that's basically saying, no, we're not ready for this. And then when it holds, if it holds, then everybody says, oh shit, might have been wrong about this DXY thing. Maybe we should get on board with this. And that's when we go to the upside. So it's that final retest. And then after you see that retest, if it does hold, that's when the market gains confidence. So we can pretty much skip over TLT since I basically just summed that up when we were looking at TNX. But essentially, we were trying to recapture the 200 exponential and simple. We are technically right now, we're watching our short and long duration bonds, treasuries basically, to see if we see any yield curve inversion, yield curve flattening, which we're already seeing. And then, eventually yield curve inversion as one of our predictors for potential bear market, or potential recession / depression. So we're seeing early warning signs of that happening. And again, if this chart went back to the 1980s, we see bonds have been going parabolic since the 1980s. So, even though we had a little dip right here, are we buying the dip before we see continuation to the upside? Or, are we just buying the lower high? So that's what I'm looking at. That's what I see